Welcome back, everyone. Next up, we have UC Asset LP. It trades on the OTCQX under the symbol UCASU and is a limited partnership formed for the purpose of investing in real estate with innovative strategies, concentrating in metropolitan areas of Atlanta, Georgia. Please welcome its CEO, Greg Bankston, and founder, Larry Wu. Now, please submit all of your questions for UC Asset LP through the webinar module. Welcome, gentlemen.
Thank you, Anna. Hi, everyone. I am Greg Bankston. I am the CEO of UC Assets, and thank you for taking part in learning more about UC Assets LP. So let's get started. Return to fast growth, innovative real estate investments in post-pandemic world. This next slide is our disclaimer, which you could go back and read over. I'm not going to read through that today. So part one, a changing world of real estate. In the 21st century, many traditional industries, such as the automotive industry, have been disrupted by innovations and technologies. Thanks. Sorry, I just lost my train of thought. But not only that, also I lost that train of thought. I'm sorry. But real estate is experiencing similar changes. Tesla, that was what I was trying to think of. I'm sorry. Overwhelming majority of public companies in real estate industries are formed as REITs. REITs are designed to distribute stable and instant cash income. REIT managers usually have less interest in high growth opportunities that take a longer period to realize. If we look at the chart here, you can see how the S&P 500 over the last 25 years performed at 11.9%, where REITs performed at 12.6%. But if we look at over the last 10 years, the S&P 500 actually outperformed the REITs at 14.2% versus a 13.2%. So real estates are traditionally viewed as safer investments with less growth potential. How is safe becoming less promising? Well, conventional real estate investments rely heavily on debt financing. It's basically a game between cap rate and loan interest rate. For example, if you buy an income-producing property at a cap rate of 6%, and have a balloon mortgage of 4%, you will make 2% on every dollar you borrow. And that is considered a safe and stable return. And if rent and income increases, which it usually does, you do get the upside. And you could also refinance and make a large bit of that capital as payback should the interest rate go down, as it's been going down for the last 40 years. The problem is that rents may decrease. But the bigger problem, the real problem is, quite honestly, interest rates are pretty much at the bottom. They're close to zero. So in other words, this strategy has been sound for the past 40 years, but may have become less promising. Growth. Departing from conventional wisdom, real estate can produce a high return on investment and high growth. So fast-growing metro house flips. In fast-growing metro cities like Atlanta, and that is where we are located, Money Magazine reported a 55% ROI in 2016 for house flips and investments. They've also looked at cannabis-related properties in the past years. A few REITs focused on controlled agricultural properties, greenhouses for medical plants, and has achieved over 100% annual growth. Technology plays a role in this too. Technologies are changing people's lives, changing the way they live, work, and travel, and redefining the concept of property. And whoever can monetize on these new trends will become the new market leader for real estate investments. Ironically, expedited by COVID, remote working is blurring the distinction between residential dwellings and office spaces. Rental owners, such as Airbnb, are blurring the distinction between residential and hospitality spaces. Most recently, blockchain technology expanded to real estate. The creation of NFTs, which is non-fungible tokens, and metaverse, a virtual reality based on blockchain, blurred the distinction between real property and virtual property. UC Assets, we are founded to grow. UC Asset is a startup real estate investment company adopting innovative models to achieve high return on investments and rapid growth in fast expanding metro areas such as Atlanta, Georgia. Let's take a look at how we're structured. We are structured as a master limited partnership, or MLP, not a REIT. So a REIT, most public companies in real estate are REITs. For the MLPs, there's only currently 4 MLPs on the U.S. public market, and we are the only one on the OTCQX. REITs, 9% of profit must be distributed as cash, whereas MLP, no cash dividend requirements. REITs may prefer properties with current or immediate cash income, whereas MLP may focus on opportunities with greater potential over a longer period. So REITs are suited for conservative strategies, while MLPs are suited for innovation investment strategies. MLP structures enables UCASU to not count on debt financing. So our debt equity ratio has never gone over 10%. We have never issued any convertible notes, despite its being a common financing vehicle of many penny stock companies. In our early stages, we relied 100% on equity financing, and this has enabled us to depart from conventional investments such as stable income producing properties with mortgage loans and to invest into high growth opportunities. Founded to grow. So this is our founders. Larry Wu is our founder there on the left, and he has managed $1 billion real estate portfolio before founding UCASU. He has a strong technological background for working with Cisco Systems as its VP for Greater China. He's also advised many technical startups. There's my wonderful photo on the right. I'm the general partner and CEO. I've been in real estate for 20 years. I concentrate on searching for high growth opportunities in real estate. And prior to UCASU, I had founded 3 other companies. Since we have expanded our team in the last few years, to the left is Christal Jordan, a guru in entertainment industry, one of the fastest growing industries in Atlanta. Some of you may recognize Kwanzaa Hall. He was a former U.S. congressman and former Atlanta mayoral candidate. And he's joined our team to lead our cannabis property and historical landmark programs. And to the right is Harris Miller, a former president of Information Technology Associates of America. So we were founded 5 years ago, and in the first 2.5 years, we've grown our book value per share by 50%. After going public with our IPO in 2018, we maintained a 20% average return on investment on our single projects, and our book value per share kept growing for the year of 2019. You can see by the graph below that we started with 2.2 million under assets under management, with $1.04 net equity per share. That was in 2016. We grew that to 8.1 million of assets under management in 2018 with a net equity share value of $1.51. And then in 2019, our total net equity share, including a 5-cent dividend, was $1.58. So our team has stayed innovative and adapted and thus achieved fast growth. For the 12 months, those wonderful 12 months from June 30th, 2020 to June 30th, 2021. So like so many other companies, we took a hit on the first half of 2020 due to the pandemic, COVID, but we quickly adapted our strategy and returned to fast growth. Since then, we've had net asset growth by 20%, all organic. Our net book value per share also grew by 20%. And we were able to hold on to cash and have a strong cash reserve of over 2.7 million. Innovation is our recipe to growth. We have proven we can achieve success by being innovative and adaptive, and we stayed on this course, and we will stay on this course. So in our early years, we started with house flipping in Atlanta, which was a great market to start with, and we also built single family properties. The year that when we started, average return on investment for the house flip was 55%. But we were aware, very aware, that this market wouldn't last. We were preparing ourselves for change from the beginning. So let's look at some of our innovative business strategies. Cannabis property. In 2020, in response to COVID-19 impact, we formed our first partnership with medical agriculture company. The deal, we had farmland in Dallas, Texas, and the deal converted our farmland in Dallas into a medical agriculture project. We partnered with a local company in cannabis extraction sector with a product line of CBD-infused bottled water products. We use this farmland as debt investment into the company, and we are currently receiving stable cash interest at 8%. The debt is collateralized by the land itself. As an upside, we may convert this debt into equity if the venture continues to succeed. First result of consistent pursuit. It's the first result of our consistent pursuit for opportunities in this emerging industry. We've been following opportunities of medical plant-related properties ever since our inception. We had made a short-term debt investment into a medical plant grower in early 2016. We had entered into a letter of intent with one of China's largest hemp farms to acquire farmland in China for hemp farming and CBD extraction in 2017. But timing is everything. So regulation uncertainty regarding cannabis products held us back, but things have changed. As a small startup, we had great concern on whether we had adequate legal resources to navigate through regulation uncertainties. And of course, we had our IPO in 2018, which subjected us to intensive SEC review, which increased our level of concern. But the situation has dramatically changed since then. Cannabis properties. Cannabis-related properties have produced some of the best performing stocks, including those listed on major exchanges. Success of those large public companies provide great templates for us to navigate through regulations. A couple of these stocks here that we've seen perform is Innovative Industrial Properties, which is on the New York Stock Exchange, and the share price soared 1,000% since the end of 2017. Power REIT share price grew 1,000% in the past 2 years since it started to expand its portfolio in controlled environment agricultural greenhouses. And on the OTCQX, which we're traded at, last month's cannabis REIT, New Lake Capital Partners, closed on its IPO, raising $102 million. So we feel the timing is just right. Demographics and political change in Georgia, where we are based, and neighboring states is in favor of deregulation of cannabis industry. We've also added the addition of former U.S. Congressman Kwanzaa Hall from Georgia onto our team, who will enhance our ability in managing risk and regulations. We are currently engaging a number of medical plant farmers, and we're ready to invest into real properties such as greenhouses and farmlands, and we expect those to become a major part of our portfolio. Another investment strategy is SHOC, Shared Home Office Clusters. This is very unique. SHOC is another innovative strategy of real estate investments, catching on the trend of the blurring distinction between home, office, and hospitality properties. A new concept of property investment in response to two current trends. So this really comes back to circling around to the pandemic and how things have changed. In 2020, remote working is blurring the distinction between residential and office properties. 56% of the U.S. workforce holds a job that is compatible with remote work. 60% of American workers will switch to working at home at least 2 days a week permanently, even after the pandemic. And then we got the travel side of things. The same year, conventional hotels are losing ground to home rentals such as Airbnb. Travel executives forecast a permanent reduction in business travel even after the pandemic, COVID-19, of around 15% less than its COVID level. But meanwhile, Airbnb will need millions of new hosts to meet demand, according to its CEO. So we had a study done on our SHOC model, and SHOC may be considered a specific category or as an improved version of an Airbnb property. Our market study showed that conventional hotels are losing customers to home rentals because of their lack of privacy and lifestyle charm. Meanwhile, customers who are not ready to shift to home rentals usually complain about the location. Home rentals are far from major airports or central business districts. As most of us know, that most of these Airbnb properties are in suburbs or in sites such as near the beach and so forth. They're not located in central business districts and such. And it's absence of business facilities, office space, conference rooms, and so forth. SHOC is designed to address the two concerns. It will combine business convenience with home style charm. SHOC is your home office on travel. SHOC will be located either adjacent to a major airport or to central business districts. SHOC will be equipped with home office facilities such as high-speed internet, video conferencing, easy access to office accessories such as printers and scanners and other tools to empower today's business travel. And we have purchased our first SHOC property. Actually, this photo that you see here is the street that our SHOC property on. And if you look at the bottom left of the photo there, very bottom left is our property there. We purchased the property in April of this year. It is adjacent to Atlanta's Central Business District. It's right across the street from Martin Luther King Jr.'s Historic Park and Museum. And it's only 700 feet from the major exit of 85, which runs right through downtown Atlanta. So, based upon our projections provided by our management partner, the IRR may reach 33% over a 5-year period. Our projection is based upon facts and assumptions, which are property was purchased with cash. We secured a construction balloon loan of about half of the purchase price. Construction cost will be about 50% higher than the loan coverage. Revenue may be seen starting from the 14th month and should reach full potential about the 24th month. Revenue and operating costs are the same to similar properties. The management fee charged us will be 20%, and the vendor fee will be 5% of gross revenue. We will look at refinancing at 50% of market value by the end of the 3rd year, and plans to sell the property at probably a 6.5% cap rate by the end of the 5th year. Another investment strategy that we have is the historic landmark investments and NFTs. It's a high-tech solution to monetize the art value of historic landmark properties without compromising their commercial value. So in 2020, blockchain technology expanded from cryptocurrency to digital art forms, or NFTs, non-fungible tokens, and soon real estate. The creation of Metaverse, a virtual reality based on blockchain technology, blurred the distinction between real property and virtual property. Land price in the Metaverse, called cryptovoxels, quadrupled in the first 2.5 months of 2021. And in June 2021, a virtual lot of land sold as an NFT in the open world Metaverse Decentraland for a record amount of more than $913,000. Long story short, NFTs and Metaverse monetize a building's intangible value or art value. Now, that does not mean the physical rights to the building. Those cannot be digitalized. The aesthetic features, histories, and societal meanings of a building and all those contributing to its art values can be digitalized. So we all know about the Empire State Building. It generates almost the same amount of revenue from tourism as from the office renting, using like a quarter of the floor square footage as its office space. So NFTs provide a state-of-art technology performing platform to digitize and monetize art values of a building in a way not imaginable before. And this, again, is the actual photo of the house that we purchased on the left. So it's our pilot NFT project. It's called the Rufus House, and it's in downtown Atlanta. It was built in 1901, the oldest Victorian mansion in the city, and it's more than 30 years older than the Empire State Building. It is located right in the heart of downtown Atlanta. If anyone's familiar with Atlanta, it sits right on Peachtree Street. It's registered as a National Historic Place since 1977, and Atlanta officially landmarked it in 1989. So we've done a lot of research and are partnering with a top-tier technology company in cryptocurrency NFT area. If successful, the NFT sale may generate additionally 50 to 100% return in the next 12 months. But this is a prime property, so even without the NFT element, setting right near the heart of downtown Atlanta, the commercial value of the property continues to grow. So in conclusion, we're advocating innovative investment models on several different frontiers, and we're very aware of our restrained financial and managerial resources. So our portfolio now consists of landmark NFTs, SHOC, cannabis properties. So we're testing the water on these 3 fronts, and we'll likely concentrate on 1 or 2 of them after we find our sweet spots. We will phase out the majority of our current portfolio, which is residential properties, to make room for new products. Meanwhile, we will actively raise capital to support our plan. We have completed our Form 10 registration. We are actively researching the possibility of a secondary public offering. And we are also open to private placements. Our door is open to accredited investors who are interested into our investment strategy. And that concludes our presentation of UCASU. Anna, do we have time for Q&A, or where are we at?
Yeah, great job. We do have some questions for you, and we have a few moments. So Abby Weeks wants you to tell us where you are focused: commercial, residential, Airbnb, and the percentage in each.
Well, we're really looking towards more the commercial side of things now. We have been focused on single family residential. Like I said, we were building new construction on the north side of Atlanta. We also did rehab and so forth. But, based upon what we're seeing, we're moving more towards the commercial aspect of things, such as the SHOC. The SHOC property, we are looking for multifamily properties that are more in the heart of the city of Atlanta, that's near the business districts or the airports and so forth, where business travelers will want to go. Now, on the NFT side of things, that doesn't necessarily have to be in downtown Atlanta. I think that we were very fortunate, and we worked really hard to find our first property being on Peachtree Street, which is an amazing location. But that is considered commercial as well, too. And of course, the cannabis side of things, that doesn't even have to be really in Atlanta. That could be in outside states. We were looking at a facility right now in Birmingham as well, too. But that's all commercial as well, too. And it's not that we're growing cannabis. We're only looking at the facilities, such as the greenhouse spaces and so forth. So it's not that we would actually be growing the cannabis.
King Espinoza wants to know, how are you currently leveraged asset to debt?
Larry, I think he's our financial guy. Do you want to answer that, Larry?
We have been very conservative when we were in the residential property area, because residential has low liquidity and usually it do not necessarily generate stable cash income. But if you choose right, residential property has a high upside. Therefore, our debt ratio has been kept very low, actually below 10% ever since. But now we are going to commercial side, particularly for properties like SHOC, which is actually a specific kind of Airbnb. So once we established stable income from the SHOC, we were looking to refinancing these properties and get more cash back into our hands. I would project that our debt ratio will rise to probably 30%, even 40% in the next 3 years. But overall, we are looking for high growth potential opportunities, not by leveraging low interest debt. That's what the common wisdom we talk about in the beginning of our presentation. That is not our investment model. So our debt equity ratio will still be lower than most of the investment companies out there, but it will be higher than what we are right now.
Okay, well, thank you guys. We have a bunch more questions for you, but we are out of time. Larry and Greg, great presentation. Please join us again with some updates in the near future. Thank you, gentlemen.
Thank you, Anna.
Thank
everyone.
you.
All right, everyone, stay with us as we transition to the next presenter. We're coming right back.